I think it's really interesting, the fact that Macy's came out last night and said that some of the holiday spending isn't quite as strong as what they were expecting, and that's really impacted a lot of consumer stocks. But the consumer is the mainstay of the US economy, so without that, then growth starts to really come under the microscope. So what we've seen in the official numbers is actually stronger than expected results coming through. And I think that this is where the market actually became a little bit more concerned that maybe the US economy was starting to reaccelerate. So even though we've had interest rates go up so much so quickly, it hasn't necessarily had the impact that the Fed have desired or intended. And they're they're desperately looking for information to basically try to substantiate, right, how far do we need to go with interest rates? And I think, when we saw some of the official numbers come through on retail sales the other day, it was stronger than expected, and it was actually quite surprising. But it's not only that, we've seen some resurgence in some of the housing numbers in the US as well. And overall, the US picture starts to look a little bit better than what it was a few months ago.
In the Macy numbers, what we were seeing too was that the discretionary spend is changing, so it's money that you really have to spend money on, even if it's in the discretionary spend category. There was worries about student loans, whether the younger customers are going to have the same firepower as they have to start repaying some of the student loans, and that overall consumers are really altering their behaviours now. That's welcome, isn't it? If discounting is now required for some of the retailers to move the stock, that is also giving us a sense that some of the inflationary numbers are coming off, at least in one category.
Yeah, and I think some of that discounting that we're seeing, particularly in the US market, so for companies like Nike and some of the other sporting goods stores, it actually has caused a bit of an inventory problem. So look, from that perspective, that's great for inflation. Having more of these discounts coming through is going to be very, very encouraging. But at the same time, there's almost a sort of bipolar type approach, because the people that have money are not necessarily affected by some of the higher interest rates, and so they're still spending. And to be honest, the top 20% roughly of income earners represent 80% of US retail sales. So there are definitely some hardship cases, and students and lower income earners are definitely feeling the pain of some of these higher rates, and particularly looking to the credit cards to be able to sort of...
Patrick, what does this mean for the markets? I mean, what does it mean for our viewers and your investors?
Look, I think it's a difficult sort of situation, but for the markets, there are two things that are driving the potential outlook and the way that we look at it. First off, if the central banks feel that the economy is starting to resurge and that inflation is not at their 2% target, they will continue to tighten rates. And I think you can very much kiss goodbye any feel for or chance for a cut in 2024, certainly in the first half of 2024.